For those of you that don't know Metrics, obviously, as Mark said, we started over 10 years ago with one investor for 75 million, and we've been very fortunate now over the last 10 years to grow our business to provide in excess of $15 billion of funding to Australian and New Zealand-based companies. Unlike other markets where the market may be big, and say in the US you get a lot of managers that might specialise in financial sponsor debt or providing debt to real estate purposes, in Australia our main competitors are the 4 domestic major banks, and I continue to expect that they will continue to cede market share. So Australia is in a situation where most Australian companies are unrated, most Australian companies don't have access to alternative sources of debt financing, and so they're heavily reliant on the banks. But what we've got is a situation where the banks are facing into increasing regulatory pressure, and we continue to see their cost of funding increase. And so you've seen the banks that can't generate the required return on shareholders' funds through large corporate institutional lending, ceding part of that market share and focusing on providing financing to the consumer. So in our market, it's very important that we focus across the entirety of the opportunity set. So corporate lending, financial sponsor transactions, event-driven acquisition, M&A financing, commercial real estate, and also project and infrastructure financing. And we do that, and we have dedicated specialist teams within our business that focus on each of those individual areas. But we do that so that when we allocate capital, we can ensure that we're allocating transactions that deliver the best risk-adjusted returns for our investors. So in private debt, it's unlike other markets where people can buy and sell over a screen. It's not a market where I think industry or sector exposure is a driver of analysis. At the end of it, it's counterparty selection, which is very bottom-up, very micro in terms of the way in which we assess and manage credit risk. Transactions are originated directly with borrowers, so you need deep relationships with companies. And at Metrics, we've got a view that we invest substantially in building good long-term sustainable relationships with companies where we believe we can do repeat business, and we provide a high level of service. We're responsive to those companies because that investment in those relationships with those borrowers, we believe, delivers better outcomes for our investors. So when we make a loan and enter into a transaction, we can't buy and sell the transaction. We're not in a liquid market where we're stuck with the credit. So bottom-up, deep fundamental assessment to set the terms and conditions to protect our investors' capital is the primary driver of our activities. Now, obviously, there's a whole range of different options available to investors in private debt. Australia doesn't have a deep distressed market. Australia doesn't have a market that is basically double B to triple C like you might get in the US high yield market. But I would argue that in Australia, most Australian investors do not need to have exposure to foreign fixed income or credit exposures. In Australia, you've got an opportunity to invest in performing companies where most of you would not have diversification across the kinds of companies that we lend to, in Australian dollars, without foreign currency risk, but also benefiting from the protections of what I believe are to be the most favourable corporate insolvency laws in the world. And so that is a significant protection in terms of investor capital. So if I leave you with 2 things today, I hope that you remember that an investment in well-diversified pools of private credit to Australian companies can deliver stability of capital, and it can be an attractive source of income. So unlike other public markets investors, our role is to originate transactions directly with companies, understand what drives their cash flow, understand their business and the strategy and the direction of the company, and then to ensure that we're structuring loans to mitigate risk. So we need to ensure that equity wears the risk of volatility, equity wears the risk of deterioration in credit quality, and you structure a loan to look through the cycle. And so we want to understand what are the key drivers of cash flow that are going to sustain the company's capacity to service and repay its debt. And then we will structure appropriate terms, conditions and covenants to mitigate that risk of non-payment, and then take security to protect ourselves. So the biggest driver in a credit decision isn't the security. The biggest driver of the decision to lend is the company's capacity to generate cash flow, to service and repay its debt. So as we highlight in this particular chart, there are structural benefits in terms of the legal and insolvency framework in Australia that provides for a situation where a secured creditor ranks in priority to all other asset classes or all other parts of the capital structure. Relationships with borrowers are very important because it is what allows us to gain access to private information to be able to assess and manage the risk of providing that financing to that company. So we want to understand and we want to compel the company to then provide ongoing information to allow us to continue to monitor the company's financial performance, how management are performing, and then move to take corrective action if there was a deterioration. So again, one of the other things that's important to think about in terms of capital stability is not only the terms and the conditions and where you sit in the capital structure. It's obviously the skill set around lending to good quality counterparties and those counterparties that you believe have good businesses, good projects that have a demonstrated track record of performance, management teams that are credible. And part of that process is then on monitoring that. And so again, as a lender, one of the ways in which we would think about an environment, if you were to sort of think about an environment where you go into an economic slowdown, that risk again needs to be borne by shareholders. And so if you project out that a business's earnings are going to deteriorate, then your covenants and controls will pick up that deterioration and allow you to take proactive action to manage that risk well ahead of a payment default. And so a way a lender might resolve that is for the company to inject additional equity, raise cash, raise equity, and use the proceeds to pay down the debt. We saw that at the time of the GFC, and we saw that at the time of the global pandemic, where companies were forced to go and raise equity at deeply dilutive prices and raise that capital for no other purpose other than to pay down debt. So again, demonstrating the superior position you sit in the capital structure, and for a lender that understands that can take proactive action to manage that well ahead of any further deterioration in the company's performance. Another alternative might be to sell assets. Sell assets as a whole, enter into an asset sale program, or sell the company or the project in total and use those proceeds to apply to debt repayment. Not great for shareholders, but certainly from a lender's perspective, our interest is ensuring that our debt has the capacity to be serviced and repaid. In the current environment, people often say to us, if we're going into a recession, how's this asset class going to perform? If I say to you that during the pandemic period, when the government and the Reserve Bank made a lot of capital and liquidity available for the market, it was probably the most difficult time as a lender to generate an acceptable return. Liquidity was strong, and so you had a compression in margins, a compression in fees, and terms and conditions were loosened as lenders chased for assets to put on their balance sheet. And obviously the banks were probably under a fair degree of pressure to demonstrate that they could be good corporate citizens and provide ongoing support. Now obviously we're in a situation where economic conditions slow down. The TFF is being repaid, there's reduced competition, reduced liquidity, and we've seen that in terms of the impact. So the impact to us in relation to that pullback of competitive pressure from the banks is wider fees, higher fees, wider margins, better returns for our investors. And if you look at our performance across a number of our funds, you'll see in the last 12 months, the spread to the floating rate of a BBSY or a BBSW has increased, reflecting that competitive dynamic. But at the same time, that withdrawal of market liquidity means that the terms and conditions that a borrower has to agree to be able to secure the level of debt financing moves in the favour of a lender. And so you get tighter terms, tighter conditions, less availability of capital, higher pricing. So I would argue in this environment, it's actually a very attractive time in which to invest in private credit. Obviously, the asset class is short-dated, cash generative, predominantly floating rate, delivering an income. Our role is to represent our investors' interests in the negotiation we have with a company. Our interest is to ensure that we negotiate those arrangements with the companies that we're providing financing to ensure that the company has access to capital, but at the same time are paying an appropriate price for the provision of capital. I believe that non-bank debt financing is a means to diversify financing risk for companies, and therefore it's a valuable source of financing, and therefore that value needs to be recognised in terms of the price that is charged to borrowers. Asset classes have all been very volatile over time, generating pretty substandard returns for investors. The beauty of private debt is obviously the absence of downside volatility in well-performing, highly diversified portfolios. And you compare this with, say, MXT and MOT. Both of those funds since inception have delivered no downside volatility or downside loss to the NAV. We've obviously seen volatility in the listed price. So if you went back in June of 2022, you could have bought MXT at a 14% discount to the quoted NAV. Today it's back up at the NAV or trading just above, now yielding in excess of 9% net for an investor. So the opportunity in listed private credit funds, notwithstanding what might get printed in the AFR occasionally, I believe presents some great opportunities for smart investors where they see that opportunity. But we recognise that not all investors want that volatility, and so we've got a range of funds that are wholesale unlisted funds that allow investors to choose. But importantly, the skill set here that drives the outcome for investors is a capacity to originate and manage transactions, structure those transactions to mitigate risk, and then obviously ensure that we're generating an appropriate return for the capital that's provided to those companies. The range of funds that we have, both retail, wholesale and wholesale unlisted funds, all we've sought to do is really say to investors, we see a broad range of opportunities in the market. It can be investment grade, publicly listed companies like Woolworths. It could be sub-investment grade companies that are private in an SPV structure, a property development transaction. Our role is to identify the risk and the return that can be delivered for investors, and to create specific mandates that allow investors to choose. What is their return objective? What is the risk that the investor is willing to take to achieve that return? And then what are the ways in which you can gain liquidity to the underlying asset classes that are held in our funds? And so we have funds through ASX listed funds that provide for daily liquidity through secondary trading on the exchange, or unlisted funds for investors that are prepared to withstand that illiquidity. Pleasingly, our funds have also been recently rated as an upgraded rating from Lonsec, so we're very pleased that two of our funds, MXT and the Metrics Direct Income Fund, are rated by Lonsec and Zenith as a highly recommended. MOT is a hybrid structure. It's a mix of private debt and private equity in the one vehicle. And so investors that are looking for equity-like income through debt and want to also participate in potential capital gains might consider MOT. For those that are looking at more defensive allocations, an alternative to traditional fixed income might think about an MXT or an MDIF. Again, recognising that the market is very broad, and our skill set allows us to originate transactions across the market, to structure those terms and conditions with borrowers, deliver the financing to those companies, but at the same time offering a range of unique investment products for clients. So the bottom line in all of this, obviously I believe that the opportunity in private credit is substantial. I believe that the opportunity to invest in a large-scale manager, domestically focused, that provides sufficient diversification to lower investor risk, can also pass on the benefits in the form of lower transaction and lower costs to investors, delivering a better return. And so when I think about investors sitting in cash, going backwards, and you think about taking on a little bit of additional risk to generate in excess of 100% of what you're currently generating in cash, I think the risk is well justified, considering the protections that are afforded to protect and preserve investor capital, and the skill set that drives fee income and margin income to deliver a return for investors. So through all of this, I believe that in the current environment, it does represent a very attractive opportunity, and I hope you'd like to consider that further. Thank you very much.